Welcome to this session on Green FinTech, driving sustainability through technology. Technology has fundamentally transformed the financial services industry, improving efficiency and risk management, and creating new opportunities, as well as driving a more inclusive society. How can we use FinTech now, though, in tackling this serious problem, this critical problem of climate change? How can the financial industry harness green FinTech to revolutionize finance once again, this time to make it more sustainable? We have with us 5 FinTech innovators to share with us their solutions in the sustainable finance space. And we are joined by Sopnendu Mohanty, the Chief FinTech Officer at the Monetary Authority of Singapore. I will moderate this session. I am Prof. Dave Fernandez. I am the director of the Sim Kee Boon Institute for Financial Economics at the Singapore Management University. And I'm very proud to say that I'm also the co-director of the newly launched Singapore Green Finance Center. The SGFC is a co-created product of SMU and Imperial College London, backed by the Monetary Authority of Singapore and 9 private sector financial industry founding partners. We answered the call that was put out at this FinTech Festival last year to help to make Singapore a global green finance hub. And we look forward to all the participants in this panel, as well as all of you listening to this session, to be part of our journey of the SGFC going forward. So let me now turn to our 5 FinTech innovators, and we'll start with Ms. Joycelyn Lim, who will present about her company, Funda.
Thanks, David. Pleasure to be here. Hi, everyone. My name is Joycelyn, crowdfunding director at Fanon. So I'm just going to quickly run through a little bit about what Fanon is and our role in driving sustainable finance. So Fanon, we're an online crowdfunding marketplace that connects 2 players. 1, responsible forward-looking investors who are looking to make a sustainable contribution in their investments. And 2, businesses out there who are trying to raise green capital to be able to embrace green technologies, digital innovation, to be able to drive some of those sustainable practices. And with that, we are able to connect the players, right? So that we enable them to empowering green businesses and also to reward green investments. But today, I'm not going to be talking about the crowdfunding platform. Instead, what I'll be talking about is the main tech engines that's behind it all, and that's our green credit scoring GCS hub and ESG monitoring platform. It's co-designed in collaboration with MUFG Digital Transformation Team in Singapore, and also the credit assessment team spin-off from a local university. So the platform in itself serves to solve 2 main industry pain points. 1, to digitalize ESG governance and monitoring, and 2, to be able to empower that scalability through various different risk models that we have in the hub itself, supported by permissible data acquisitions, making sure that we adhere to various different data regulations as well across different jurisdictions. So we know that the support for sustainability is there, but there's still that green financing gap that needs to be met. So how do we then try to do that? We're able to facilitate the flow of green capital into impactful investments by having an effective ESG score integration, especially when it comes to risk management. So essentially what we're trying to do is to be able to transit ourselves from the blue box that you see, where predominantly the common practice is companies out there just making that risk assessment with a credit score, into the rate section there, where we introduce an ESG score and we merge it together with the credit score in itself to be able to compute some form of a risk assessment that this time around doesn't just take into account the financial performance of the company, but also its impact on the society, on the environment, and also on the planet, which then of course determines the credit decision making itself. So traditionally, I think, just the process of getting to those scores, right, it's rather complex, onerous, and it could be very manual. So with the GCS hub that we have, it basically digitalizes all of the ESG governance as well, and to be able to help to speed things up a lot faster. And that's because we want to be able to support rapid adoption, right? Especially when we see that ESG integration is, moving from a nice to have to somewhat mainstream and eventually a mandate. So I won't talk too much of the ins and outs of this entire platform, just to focus a little bit on the red dotted section, which is the GCS hub that we have that houses all the various different risk models, right, in the model pool, with all of the aggregated data as well, seated separately, and of course the calculation engine on it as well. So then, how does the GCS hub empower scalability, it's through the transfer and extension modeling and also the constant refinement of that model as well. So if you take, for example, if you are an investor or a green fund manager who's looking to sort of deploy some funds in, say, a cocoa green project, prior to that, you would need to make some form of sustainable and risk assessments, credit assessments. And instead of having to build that model from scratch, what you can do is having access to that green GCS hub, you can actually sort of pick, various different existing models of the other domains, in this case, the palm oil model, take it through, right? And pick specific parameters and transfer that learning over to your model, which is the red section there, over to your light blue model in itself. And if you think about it, it's essentially somebody who already knows how to ride a bicycle, and he or she needs to sort of pick up motorbike riding, right? I reckon that he or she would be able to pick it up a lot faster versus somebody who doesn't even know how to ride a bicycle, because of that transferred knowledge of being able to do balancing techniques, for example, on a bike. So it's this reusability factor of the entire GCS hub that allows a lot quicker deployment of all these various different models out there, and of course scalability as well on both a locally and regional level. So beyond just that green credit scoring section, right, that's digitalized, the team itself also recognizes the need to be able to do that form of ESG monitoring as well on various different ESG indicators. So here's just an example of a heat map out there, whereby once the funds are deployed, you can actually see how the funds are being used, right? Ensure that they're not being misused in this case, right? And that SDGs considerations are still all in place and aligned. The map itself is interactive, so you can actually click on it and in real time and find out a little bit more about the various different risk factors, look at the relationships between the different farmers, the mills and the traders as well. Okay, so that's the end of the presentation. So we are very keen to speak to green funds out there, right? Asset managers, fund houses out there who are looking to integrate and ESG factors into their credit lending decisions, their investment processes, their portfolio constructions, as well as even players out there who have tech to be able to, that could facilitate data capturing. And earlier on with that crowdfunding platform as well, any businesses in the sustainable industries looking for funding, and any investors out there looking to have that sustainable contribution to their investments, please feel free to reach out. All right, thank you.
Thank you, Joycelyn. Let me turn over to Andrew Gazelle to tell us about ESGTech.
Thank you, David, and it's a pleasure to be here today amongst this distinguished panel, and MAS, thank you for the invitation. My name is Andrew Gazelle, and I'm the founder and CEO of ESGTech. We're all aware that there's a diverse audience that log into Singapore FinTech Festival each year. So what the ESGTech team decided to do was to put together a short clip which helps provide an insight into the opportunity at hand, some of the challenges that are faced by stakeholders in this at the moment, and then also how ESGTech utilizes technology to extend the growth of sustainable finance. With that said, I will play the clip.
ESG stands for Environmental, Social and Governance. ESGTech is a homegrown, Singapore-based, next-generation ESG data exchange platform. We're here to help financial institutions take advantage of the market opportunities and manage future risks and regulatory frameworks. We are a verified ESG data exchange specifically focused on servicing the relationship between financial institutions and their corporate clients. Our main objective is to accelerate the distribution of sustainable finance in a verified, scalable manner. The market opportunities can be viewed through two distinct lenses: the commercial market opportunity and the optimization of regulatory compliance. IFC forecasts more than $23 trillion in climate-smart investment opportunities. Sustainable debt issuance has grown 17-fold since 2012, and last year, over $563 billion sustainable debt was issued. This hugely growing market needs better and cleaner data, stronger regulations, and more informed decision makers. And that is what ESGTech is here to help you do. Smart, innovative regulators like MAS understand that better, cleaner data enables fairer decisions to be made. They also recognise Singapore's responsibility to be at the forefront of this emerging world, a competitive and comparative advantage for Singapore. Equally, the financial institutions that operate here in Singapore and beyond are well aware of the upcoming regulations in 2023 around Basel. At At the heart of this, financial institutions need to completely rethink how risk-weighted assets are assessed in order to mitigate exposure to direct fines and actions taken by their corporate clients. One of the biggest challenges financial institutions will face from upcoming regulatory changes will be the issue of cleaner data and finding a better and easier way to engage with corporate clients in a verified framework. At ESGTech, we've been working on this challenge through market engagement, technology, and academic partnerships for the past 2 years. We now have a solution that can support financial institutions and adhere to upcoming regulations and future compliance requirements. The great news is most financial institutions want to be part of fixing the problem. They want to support their clients to be more sustainable and profitable. They want to help their clients' operations in this challenging and complex transition, and they need a trusted partner that helps them make sense of this changing world. ESGTech is that partner. We are a platform that understands the questions being asked by financial institutions. Do we have the operational sector knowledge required to correctly assess a corporate client risk across the globe and at scale? Do we have too many people, processes, and therefore costs to get the information to make a smart decision? Do we have a material size data set to enable a deep and wide benchmark of market conditions? Do we have the governance to adhere to the legal obligation and insurance related to holding and verified corporate client data? At ESGTech, we are a business helping to answer these questions. ESGTech advances the acquisition and verification process for material disclosure of ESG data for underlying assets and for fixed and alternative investment classes, enabling the scalability of sustainable financial products. We do this by creating a data exchange platform which provides value to both the corporate clients on one side and the financial institutions on the other. Corporate clients are provided with client-facing tools such as compliant ESG reporting, peer benchmarking tools, and operational analytic tools, all to help further enhance one's business and support their continuous journey to be more sustainable. Financial institutions are able to accurately assess risk and seek out opportunities, take advantage of standardization of client onboarding through automation, review their ESG-related assessments, and utilize verified, clean structured data for scenario analysis and optimization of institutional reporting. But most importantly, the ability to scale the distribution of sustainable linked financial products to the market and provide access to cheaper capital for both the financial institutions and their corporate clients. Our key advantages are helping financial institutions to correctly size and price corporate risk, automating labour-intensive process workflows found throughout the management of client relations and ESG risk assessments, and speed to market for KPI-linked financial products, including bonds, loans, and credit facilities. With the support of our trusted partners and financial institutions, we provide clear value to both sides, creating new commercial opportunities and optimizing costs to serve both, which have a direct impact to balance sheet performance earnings. We've listened to the market, providing a solution that integrates into existing financial and operational systems whilst planning for continuous digital innovation. Regulators, stockholders, and societal pressures are driving corporations and financial institutions to both reflect internally on how their businesses operate and transact with one another. If you are a financial institution currently discussing these challenges, we would love to hear from you. So please get in touch with the ESGTech team today.
Thank you very much, Andrew. And now we'll turn to Bhavan Sukhdev from GIST.
I'm Pavan Sukhdev, the founder and CEO of GIST, a company whose mission is to make sustainability accessible to all. Doing that without technology was clearly not possible, and that's why we fully embrace technology. The problem that we are going to try and solve with your help on the Global FinTech Accelerator Award template is the problem of water scarcity and the related problem of the huge losses that can be faced by companies who are involved in creating that water scarcity and who are suffering from that. To give you some statistics, more than 3 billion people today around the world, especially in agricultural areas, suffer from severe or high water scarcity. And this situation has worsened 20% over the last 2 decades. More than 3/4 of companies surveyed recently say that they are exposed to substantive water risks. Honestly, For investors today, there is a further problem, which is that if they rely on the 600 plus ESG rating methodologies, none of them actually give them a value, an actual monetized material assessment of how much is the impact of a company or an agricultural producer on water scarcity. In other words, they could be sitting on their loan portfolios or their asset portfolios on companies whose externalities today are going to be risks tomorrow and losses day after tomorrow. And they are facing negative alpha without the means, the technology and the means of measuring that. That's where we come in. We have already launched the world's first digital 360-degree impact valuation platform. I know this is a dream for many people. We are proud and pleased that we've actually done this in June this year, which measures impacts on natural, human, and social capital, in addition, of course, financial capital. But what we've done further for the 3-week sprint that we've been involved with is to use our existing platform for measuring water scarcity and its impacts on agriculture, on human health, and on industry, to use that to actually drill down one level further and find out who's affected. Is it agriculture itself? Is it the local communities in terms of residential users? Or is it industry hurting itself through its excessive use of water in water scarce regions? We do this right down to a grid of 50 by 50 kilometers, so much narrower than the basin level, which most people do. We have 5 patents lined up in this space, and we are told by our corporate partners and investment partners that they will find this useful to give them insights and clarity on where actually is the water risk in their own portfolios. Let me then give you an example at the investee level. This is a recording. I'm taking you through how an investee company, private equity perhaps, will enter into our system, enter the water consumption, also enter offsets such as harvested rainwater and recycled wastewater. And then, having done that, among other things like air pollution and greenhouse gas emissions, it will go and check out the results of that calculation through its overall report section, natural capital externalities, including, of course, water, and looking at water consumption. The company here was one of the 10 companies given to us by NN Investment Partners. It's called Novozymes. It's in the biotechnology space, based in Denmark. So there, its water consumption impact is $300,000. But if you look at its factory in Tianjin in China, that is much bigger. It's actually $13 million. And that's the rub, that we need to be able to give investors, such as our corporate partners, the ability to work out the water risk premium. You can see that in China, of course, most of the risk is on the agricultural side, as you'd expect, whereas in Europe, it was mainly on residential. In Europe, the premium was only 2.45%. So it's 102.45 shadow price as against 100. Whereas in China, the premium is a staggering 448%. These kind of insights provided by our platform, as well as other insights, obviously, on other aspects of the environment, are where our technology, I believe, can be truly valuable. Let's take this assessment off from the investee level, in fact, go to the portfolio level. As I said, we've run through a sample of 10 companies with 10 comparatives, and this is for Novozymes and 10 of its peer group, mainly Japanese companies. So you can see they're actually, through their technology, very low. But there is one, Kyowa Kirin, which has purchased a recent unit, and that is highly polluting on water as well as waste. And those waste and water impacts make it much worse than Novozymes itself. So this is the kind of detailed analysis that our platform can provide. As I said, we go down to 50 by 50 kilometers. This is much, much granular, more granular than the basin level analysis. I must thank our team, led by our Chief Technology Officer, Rajiv Kumar, who's incidentally one of the co-creators of the Bluetooth protocol, as well as Anupam, Sneha, Maria, Siddharth. And I'm delighted that we've been able to deliver this within the 3-week sprint timeframe. And we look forward to working with you guys and taking this to the next level. Thank you.
Thank you very much, Pavan. And now I'm going to turn to Marc Mettler from Third Eyes Analytic.
Yes, thank you. My name is Marc Mettler. I lead business development at Third Eyes Analytics, the wealth tech that translates how rising temperatures impact wealth development of clients, as well as the probability to achieve their goals. Despite a lot of data, it remains unclear how investors shall streamline their investment decisions in light of climate change. Let's have a closer look why and how climate change affects investors. We know from extensive research that significant climate change will affect economic growth. This was demonstrated by Professor William Nordhaus from Yale University. He has won the Nobel Prize in 2018 by demonstrating that rising temperatures affect GDP growth significantly if they exceed 2 degrees Celsius. We also know from research that economic growth is a key variable in explaining the expected returns of different asset classes. Therefore, if a rise in temperature reduces economic growth and consequently also investment returns, this also directly affects investors. We offer financial institutions various solutions and capabilities for wealth and life planning. They realistically and instantly simulate wealth development and goal achievement in thousands of scenarios, including fat tails and climate change. They optimize the strategic asset allocation to maximize goal achievement and enable mitigation of climate change impact as part of the portfolio construction. Let's have a short look at our solution for advisors of financial institutions. Our client is Lisa with bankable assets of 835,000 euros that can be reallocated into an optimal asset allocation. Lisa's bankable assets consist of cash, equities, and bonds. She wants to ensure that she can keep her living standard during retirement with 6,000 euros per month and preserve a capital of 200,000 euros over her entire lifetime to have a cash reserve at all times. You'll see here the monthly savings rate of 250 euros she additionally has. On the right side, we see her wealth development in thousands of capital market scenarios, while 3 scenarios are outlined specifically: the expected case, the good case, and the adverse case. Below, the green bars indicate that Lisa can reach her goals in the expected capital market scenario, but has a financing gap in the adverse capital market scenario of more than 300,000 euros. Looking how a 3-degree temperature increase affects Lisa's situation, we see that she cannot achieve her goals anymore in the expected capital market scenario. The financing gap in the adverse capital market scenario increases, and she now has a liquidity problem at the age of 77. If we optimize her situation by means of a bespoke strategic asset allocation, we see that the new asset allocation improves her goal achievement, both in the expected scenario as well as in the adverse capital market scenario. This might be surprising, as the new optimized asset allocation on the right side includes more equities and less cash and bonds, which we see just now. Fact is that the long time horizon is beneficial for Lisa to finance her living standard until expected end of life, even in the very adverse capital market scenario that considers non-normally distributed scenarios as well. So the question now is how to create a portfolio out of this optimized strategic asset allocation. For this purpose, Lisa can indicate her investment preferences, not only in the ESG context, which we show here, but many more. Based on those preferences, Lisa gets a bespoke investment proposal that answers why a specific investment product has been selected for her. The matching score that you see answers how well an investment product fits her investment beliefs, while the quality scores outlines the quality of the investment product. Both combined lead to the best fit score, which serves as basis for the investment product recommendation. This is how we at Third Eyes Analytics use existing climate-related data to help financial institutions streamlining investment decisions for their private and institutional clients. We first assess the impact that climate change has on financial goals, then optimize the strategic asset allocation individually, integrate the impact of climate change again, and last, propose those investment products that fit the client's investment beliefs and quality requirements best. Why is this all credible and relevant? Well, because our founders, our head investment center, and our quant team all have decades of experience, both in financial modeling and sustainable investing. Thank you for your attention.
Thank you very much, Marc. And now we'll turn to the last of our 5 FinTech Innovator presentations. And I ask Areti Kampyli from Alice.
Okay, perfect. So, hello everyone. I'm Areti Kampyli, founder and COO of Alice. So let's see what we do at Alice. We introduce data analytics in the impact sector, and we do that on a completely decentralized, therefore very secure web infrastructure. So why is this important, and why are we doing all of this? We live in an era where there is more and more demand for accountability. donors, funders, foundations, governments demand proof of impact to be able to fund, invest, or donate in social and environmental programs. The people that are required to report on the impact of their work are the social enterprises and the corporations. And those guys, they engage in very time-consuming and costly processes because they literally cross-check databases manually. On top of it, every time they have a new project on board, they create bespoke pieces of software and databases from scratch. And they do that in fear of any data loss or hack. And most importantly, in fear of their investors seeing potential failures of theirs, and therefore hindering their funding. Now, this bespoke and manual admin expenditure can reach up to 30% of a project's total budget. And alarmingly, in 2019, that reached $150 million globally, which is essentially money that could be spent on the delivery of those social and environmental projects. These are precisely the issues that Alice is tackling. We automate the analysis of impact data of social enterprises and organizations down to each beneficiary, and we're able to predict the performance of the projects by applying machine learning algorithms, and all of that on a decentralized web infrastructure. And let's look at an example of what we do and how. Here's our work with the Vodafone Foundation. One of Vodafone Foundation's programs is the digitization of schools in refugee camps in 4 countries in Africa. With our impact analysis and visualization, they're able to see how much better their students did in their exam results compared to the national average, and of course, amongst the different countries. Another example is our work with Resonance, which is the UK's largest property impact investment fund. What they do is they give apartments, housing essentially, and a monthly allowance to former homeless people and former prisoners. And here they can show to their donors how much of their funding went to the beneficiaries and how the beneficiaries used it, saved and spent it. Now, all of that happens in a completely decentralized web infrastructure. And as jargony as this may sound, very simply put, it means that we're operating on a completely serverless environment. So no central server means that we're not controllers of data. We don't control the data of our customers because they don't sit anywhere. Also, data loss or a hack is practically impossible in a serverless environment. And thirdly, we fully protect the privacy of the beneficiaries so that they can benefit from those programs in a very dignified way, because no one can ever have access to their data, either personal or data created by the program. Now, by gradually incorporating different impact investment measurement frameworks, we will be going up the customer acquisition ladder from foundations and impact investment funds to corporates and then government. And the markets in which those customers of ours fall into are very impressive in size and have substantial growth annually. 3 trillion is invested in social services every year globally. And in ESG investments with ESG essentially principles, 23 trillion is invested. Out of those, investments in specific ESG data amount to 1 billion per year, and they show an annual growth of 20%. In these markets, we apply a 3-tier business model, free for those that want to see data samples to design their own programs, a self-service tier without the machine learning recommendation, and a full recommendation engine. But the important thing here is that, as you see, just spending up to 90 essentially dollars per user per month, we're saving thousands of dollars per month for every social enterprise and corporation who's obviously reporting on their impact. So far, we've raised $1.2 million, and we've established ourselves in the UK with clients like the Vodafone Foundation and property impact investment funds. Now, as of last month, we're going to be the official representative of a New Zealand impact investment marketplace, both in Europe and in Asia. And we're going to open shop in Singapore to establish our presence in Asia. Now, we're looking for partners and customers, so we really look forward to speaking with you. And what you will get by working with us is the full automation of your impact reporting, so you can shift your resources, both financial and personnel, to the actual delivery of your programs, and all of that in a completely secure, decentralized infrastructure. Thank you very much.
So now that we've heard these 5 exciting presentations from our FinTech innovators, I want to turn to Sopnendu. FinTech is very pressing. We're all moving forward quickly, but really there's nothing more important for us to work on than the problem of climate change. What is the way forward for this? How can we really make this happen and happen fast?
You know, there's a bit of a opportunistic move for FinTechs in this space, because traditionally FinTech has relied on data to think about new solutions, a new way of running finance. So Green, inherently by design, is also going to be data driven. And the FinTechs are well prepared over the last 10 years how to run algorithms, how to do provenance of data, how to build trusted golden source of databases. They know they have a whole set of predefined or preset skill set within the ecosystem, and they can easily morph these solutions to this green space area. When in fact I was arguing that the policymaker may have run ahead of the technology availability in this space. I think having the FinTechs, especially in the space of financial sector, to expand the solutioning to this space is critical. In my mind, there are 3 areas which I think we all have to focus on. One is on the financing side, because when I started talking about FinTech 5 years back in Singapore, the first thing we got to think about how to raise capital for the FinTechs to even build solution. So there's a whole set of mobilizing finance requirement for us to think about, especially small FinTechs who are trying to build solution in this space. Very hard to get investors to come behind and support this FinTech. The second piece is around how to monitor once a green commitment is made. Suppose somebody gets a green finance, there is a commitment made on KPIs. Who is going to monitor all this data? There's a whole set of technology required in the monitoring side. And the last piece on the measurement side. And again, more technology required. We've got to measure all this impact and find a cute and a creative way to get it and show it in a way consumers will start shifting their behavior. The asset managers will be incentivized to show more green asset for better investment. So there's a whole set of opportunity which opens up new doors for the FinTechs. And I'm pretty sure, even you saw the Stripe. I was looking at a Stripe latest valuation, and I saw the Stripe Climate has a new addition to the Stripe portfolio. So every FinTech is now shifting a part of its thinking to this climate space. So this is a good opportunity for us. I think we're going to look deeper, and hopefully we'll get there very soon.
Outstanding.
And we are MAs thinking about launching a platform called Green Print.
Okay.
And the Green Print will have all these 3 components which will mobilize the use of technology in this space.
I look forward to that. Well, let me ask some questions of our FinTech innovators. Maybe I'll start on for the 3 online, and then turn to our 2 panelists who are here joining us live at the Singapore Expo. And let me ask you about your individual companies and your experience in this ecosystem of Green FinTech. We have our erstwhile regulators, represented here by Sopnendu in the MAS. You have a lot of NGOs who are out there who are helping to set standards and to have their input. And of course, there are the other private sector players, the very large financial institutions, as well as folks like us, academics and others who are trying to sort through all of this space. How is your experience in pushing your company ahead and your ideas forward? How do you find yourself leaning in that ecosystem? Is it really the regulator who's prescribing the areas where you can work that sets your agenda? Is it the needs of the private sector and the big financial names in particular? Or is it the standards that are being set by these NGOs? Maybe I can start with you, Baba.
The big change that has happened over the last 3 years is really there's been a tsunami of interest from the asset management community. everyone is talking and actually asking questions about, well, yes, we used to measure portfolios in terms of modern portfolio theory, in terms of risk and return, but now there's a third dimension. It's risk, return, and sustainability. What do you have for that? How do you measure impacts? How do you value the impacts? What's this mean in economic terms so that we can truly link it with materiality? These are questions that really were not being asked 3-5 years ago, even 2 years ago. And of course, the leaders in the corporate sector have been, for a long time, interested in exploring their impacts, their company's impacts on the environment, on society, and so on. But that's been very few. And literally, we're talking about 40 to 70 companies who've been working in this space. My own firm has been involved with them. But the tsunami is on the investor side, there's no question. And of course, now the banks, and I believe next the insurers will start waking up on this as well. I believe the awareness creation is already happening, but I think setting the standards and setting the rules and regulations, the rules of the game, so to speak, that's really where the regulators will come in.
Thank you. Maybe ask Marc. I mean, Bhavan has pointed to various players in the ecosystem, but the asset management stripe in particular. How about you? How do you find yourself leaning? Who's setting your agenda?
I mean, I would say we set the agenda to a big extent ourselves, because I mean, we're a Swiss company active in the international context, so the regulatory bodies do not set our agenda. I mean, they're completely different. MAS has a different approach so far than the European Union, and even more so the Swiss regulator. So I think the alignment is not there yet. I mean, we aim to differentiate in the climate change context beyond what is regulatory required. And our idea is really to make the impact of climate change tangible to individual people, and to mobilize people to contribute their tiny bit to mitigate and to reduce climate change. We do that, as outlined in the presentation earlier, by making it tangible onto their expected wealth development, and making it tangible also on by showing how it affects the probability to achieve their goals. So actually, we set how we proceed. I mean, it's our agenda which we set, and obviously we're aligning with the regulatory bodies. But the idea is really to give a tool at the hands of financial institutions, to make the impact tangible onto individual investors. Because if we look at asset management is much further advanced with regard to sustainable investing than the private individuals. And I think this is the next step which we should see, and the multiplicator which is needed so much.
Thank you, Marc. Areti, same question over to you. Across the ecosystem, how do you find yourself leaning?
Yes, thank you. So for us, as well as a regulator, and MAS is giving us an amazing opportunity here. We were one of the first companies actually in the UK's Financial Conduct Authority's sandbox to see what the regulations should be for blockchain. And equivalently now we have the opportunity with MAS. But for us, it's not so much setting those regulations that will allow us to work with the financial institutions. It's more about these sandbox opportunities, these experimental opportunities that they're opening up to companies like us to basically enter the previously walled gardens of the financial institutions. So, for example, like over the accelerator, we've been speaking a lot with HSBC Singapore, Citibank Singapore, and they have, internal pieces of software that may do to an extent what some of us are doing. But the problem is that they create these proprietary software and silos because they do it, again, they're reinventing the wheel every time and do it themselves. So the opportunity through the regulators for us is to open the doors to the financial institutions, for us to come in with their innovations where we've experimented and tested in other markets with other customer segments, and bring that know-how, R&D, innovation to the financial institutions that can expand their product output, impact measurement, ESG compliance, and all the rest a lot faster and better than doing it again and again themselves.
Thank you. On the stage here, why don't you ask Andrew, can you talk about the ecosystem and how your firm finds itself in?
Yeah, look, I think that the regulator has a big part to play. I think they can be the safety net, or they can take a lead in innovation and provide the opportunity for fintech festivals to integrate into existing financial institutions and provide, as Sopnendu said, provide the opportunity to verify the data and then to structure it in a format, and then the insightful investment decisions can be made. And that's really where we focus in on is that verification aspect of data at scale. KPI, or sustainable linked financial products, are no different to existing products, only that metric. And for it to be verified is key, and that's going to be a big aspect moving forward.
Last but not least, Joycelyn.
Yeah, thanks, David. So I concur with all of the panelists out there. I do think that this year is going to be a breakthrough of proof of concepts, especially with a lot of support from MAS as well. So I'd just like to highlight the point on, I hear a lot about monitoring, right? So you can have those ESG green credit scorings in place, and that sort of kickstarts the entire process. You get the investments, you get the funding, but what happens after that, right? How do we actually ensure that the borrowers out there who are getting the funding, how do we ensure that they stay committed to the ESG criteria that they have signed on upon? So I think, with technology in place to be able to sort of digitalize that ESG monitoring, it all takes us back to the fact that I think with COVID-19, there's so much more to do, especially in a distance. I think having that monitoring in place, and that's something that FundOn is also what we're trying to do. In this green credit scoring hub and monitoring platform that we have, what we're trying to actually enable is to be able to get that monitoring throughout there, whereby, for instance, if upon deployment of that capital itself, you are able to sort of get in monitoring in terms of what the investment outcome is. So for instance, you can see what the farmers are actually utilizing the funds on. Are they misusing the funds? Are they perhaps expending their farming expertise on, protected areas, for instance, or converting like peatlands into more farming areas, or using even fertilizers that, would actually harm the soil. So I think things like that, it's important. And that's why, through the proof of concepts and things like that, which a lot of support from MAS, we are trying to sort of develop some form of a dashboard that's interactive that allows both investors, green fund managers to be able to do that form of monitoring, being able to sort of see exactly what the risk models are like, on various different ESG factors. For example, it could be a dashboard, a sustainability heat dashboard, for example, that's on the sustainable land use, right? Things like that. So I think, I definitely concur with everyone here.
Yeah, so now that you've heard, all 5 of our fintech innovators respond to my question about within the ecosystem. Obviously, the regulators come up every time in various forms. In general, as a motivator of this space, how do you see your role? But also, because this is a global issue, and that is climate changes, and of course, technology and the financial services sector is global. Marc mentioned sort of a lack of alignment as regulators in different jurisdictions who are clearly critical in each one of those countries. If you could respond to some of the things you've heard.
Look, I have a very provocative response to that, and a general response to what everybody said. That regulators would play a role in defining, helping the devices to capture data, standardize, and public utility to capture golden source data. Then the rest of them can build solution on top of that. During the Fukushima crisis in Japan, there was this organization called Safecast. They were not convinced with the government data coming out of post-Fukushima about the environmental impact. So this organization started creating citizen-centric data collection. What they essentially did, they created small devices, gave it to people like us, and we are living in a space, wherever we are living, we can capture all the environmental data and pass it to the cloud. So there's one thought process that you decentralize the ability to collect environmental data to ordinary citizen. Let the citizens capture the data in little small devices. Maybe as technology improves, our mobile phone can capture the environmental data, and that can be sent to cloud. So wherever the assets are getting created, if it is impacting the environment, the independent data collection process gets strengthened through the citizen-centric data collection process. And you can all check the Safecast website, how they have done it. That's one way of doing it. Decentralizing, let citizens get empowered in collecting data, that gets through a cloud, and we can have access to an independent data source. Other one is more orchestrated, public infrastructure. build the necessary public infrastructure to capture data, especially monitoring commitments, measuring post an asset is deployed to the lifetime of the asset. Is it really committing to the KPIs? That's the other way to look at. But generally speaking, I think both the models will work, but that will also bring to the discussion, the center of discussion, which I believe may be related to green, but in a broader sense, the rise of data protection. Because progressively, during the pandemic, post-pandemic, you will see some sense of that is the rising data nationalism, where countries will start clamping down the access to digital data for various reasons, value captured and other motives behind it. So if that happens, then we have other challenge. So I think the regulators and the countries should start talking about trusted data corridors where they can access each other data for a greater social good, especially in the climate space.
Excellent. I see I'm watching the clock here, and I can see that we have maybe time for each of the panelists to say something about the way forward, to say how we can push this space of green fintech and your particular agenda in that. So let's go lightning round here. 45 seconds. We'll go in reverse order that we just did. So Jocelyn, I'm going to ask you to kick off. Way forward, what would you like to see happen? What do you hope to see happen?
I think definitely with the regulators out there, there must be some form of standardization that comes into play. And I think the sooner we get there, the sooner we can all harmonize and get together and be able to move forward. I think that the future of finance really is about greening the entire financial system. It's the way forward to be able to let us be able to spend, use, and grow money better. And it also allows us to be able to meet the needs for today and ensure that the future generations to come will also be able to have their needs met as well.
Thank you, Anne.
No problem.
Look, I think definitely the solution is a technology-led solution in order to scale and distribute sustainable finance. And I think, in the not too distant future, sustainable finance will just be called finance again, because the verification of that data will just become a common norm as we saw in history before.
Areti, could I turn to you, please?
Yes, thank you. Collaboration, like you guys do, between the innovators and the financial institutions, so that we cut down on expenses of the basic tech, like admin expenditure, management, and we standardize those so we can actually spend money on the programs. Like in 2019 alone, $150 million was spent on impact measurement software and databases created from scratch, and admin and management. That is money that can well go into the actual execution of the programs rather than reinventing the technology every time.
Marc?
Yeah, so you mentioned regulatory bodies first. I don't have anything against that. I think to set a decent minimum standard, it makes absolute sense. I think what is more important even, and I see that happening in Singapore, so a big compliment to that is to create an ecosystem which supports the new players, which effectively support all the climate change efforts to mitigate that. I think that's very good, and that ecosystem and the support of new entrants, I think that's critical going forward. And I would like to see that more happening in Europe, similar to like it's happening here in Singapore.
And Baba?
I think actually the regulators have a huge role to play in ushering in what I see as an era of impact transparency. Today, the only transparency of impact we have is the financial impact of corporations, and that's because of balance sheet and profit and loss being published once a year based on IFRS or your local accounting regulators. Tomorrow, I see an era where citizens and of course investors, most importantly, and companies themselves and the regulators can see the impacts of the corporations measured and disclosed using standards that the regulators, including the MAS, have ushered in, have introduced and said, look, we need to start measuring and managing and reporting by standards, not just the impact on shareholders, but the impact on stakeholders. That's the kind of vision that I believe the MAS and other regulators around the world can usher in, impact transparency for everyone.
Well, I want to thank everybody on this panel for contributing to this discussion on green fintech and driving the sustainability agenda forward. Technology is at the center of it, and I think when that's true, we don't really know where it's going to go. And I think that the ecosystem is going to have to work together The regulators certainly, plays a role. We as academics, we hope that we can help to cut through a lot of the marketing and showbiz that's a part of always of this industry, but that to try to see how we can work together at this critical problem of climate change. When we think about how we at the Singapore Green Finance Center, our newly established center here to make Singapore a green finance global hub, are going to operate, though, we want to lean toward people like you, to the private sector, because it's the innovation and the harnessing of technology where we don't know where things are going to go. We have our regulator keeping us in line and motivating us to move forward, but we're going to look to you, to the private sector, to drive those solutions, and we look forward to more conversations about this critical issue. Thank you very much.